And one thing that's very testable is the additional documentation to open a margin account. So, the two basic types of accounts at Goldman Sachs is a cash account where you intend to pay in full, and a margin account where you intend to pay part of the purchase price and you would like Goldman Sachs to lend you the difference, right? And so if you're going to open a margin account, we need a credit agreement. And that's where you acknowledge that you understand you're borrowing money and you're paying interest on that loan, and that's mandatory. Now, the interest we charge you is based on broker call. And so this can be a very, very competitive loan. So a lot of people like to borrow against their securities, instead of selling their securities and paying a capital gains tax, right? The second thing is we say you're pledging your securities as collateral for the loan. That's called the hypothecation agreement. And that's very important. That means you understand that if you don't meet your responsibilities, we're going to sell you out. Now, that means your securities are going to be in street name. And what that means is these securities are in the name of Goldman Sachs. Because again, it's like a car loan, right? You're hypothecating your car, you don't get the title of the car. I'm having a cabin built, and I like this guy. This off grid with my brother, basically, different community altogether. But the guy was telling me he's down a few payments on his water truck, but since we're off grid, there's no way they can find this thing to repo it. And I said, well, I wouldn't count on that. They have flow jacks. There's guys who get paid to do this, and I think he's relying a little too much on that. Nobody's going to repossess that, right? So. That thing is not in his name. The truck is in the street name of the whoever the lender is. Now, the one thing that's not mandatory is the loan consent form. This is where we say, listen, we have other Goldman Sachs customers who wish to sell short securities. Would it be okay for us to lend them your securities? And that part of the document is optional. That's very testable. To know that the loan consent form is optional. As you say, hey, Dean, it's not in my best interest, I don't think, to help people establish short positions in securities I'm long. I say it's not, and that's why that piece of the document is testable. So let's say that you want to buy 1,000 shares at 40. Buy 1,000 shares at $40 a share. So that's going to be $40,000. And what I'm going to say to you is, Joe, do you want to do this in your cash account or do you want to do this in your margin account? If you want to do this in your cash account, I'm going to want $40,000 from you because, you intend to pay in full. Or do you want to do this in your margin account? Would you like Goldman Sachs to lend you a part of the purchase? And you say, yeah, let's do it in my margin account. Assuming you got the documentation in place. I say, okay, we'll do it in your margin account. Now, this is our first major thing. This is called the classical margin equation. You're going to have $40,000 in what we call long market value. I think the best analogy is a house. Market value of the house minus mortgage on the house equals equity in the house. Equity always represents what you would have if you sold the house and you paid off the loan. Nobody's suggesting you do that. And the house goes up in value. Maybe the bank says, hey, you got excess equity in the house. We're willing to advance you a further loan. Now, the mortgage on this position, what you owe your brokerage firm is $20,000. And that's called the debit register or debit balance.
That's Reg T.
That's right. Well, Reg T is actually the amount you have to be at risk for. So right now you have a margin call. You have a margin call for $20,000. So your point, though, Reg T is the loan value. I can loan you up to $20,000, and that's what I've done. And so this is called your equity. And that's going to be what you need to send in. Now, test point, regular way settlement is between broker dealers. So T plus 2 is between broker dealers, but customers actually get 2 additional days. So they actually get T plus 2 to come up with this $20,000. We don't tell them that because we don't want to use our money to settle their trade. But as a margin clerk, I can't reach out to you until T plus 2. Then I say, hey, Joe, margin clerk here, where's that $20,000? Now, if you're a customer in good standing, it's very likely I'm going to get you a couple extensions. Then I get a mailgram. You flake, where's your money? And then at some point I'm going to sell you out. I'm going to say, well, listen, you never paid for it. So that means you bought that stock, you sold the stock, you never paid for the buy. That means you took a free ride, a ride you did not pay for. And I say, Joe, what I'm going to do to you is I'm going to freeze your account for 90 days. For the next 90 days, you have no credit privileges. Why? Because you took a free ride. We have pretty liberal credit privileges. Now, what we always want to do is see if perhaps we can't loan you more money. Because loaning people money is one of our all-time favorite things to do. Retail commissions at most firms is like number 5 on the income statement. Financing debit balances is, where we make a lot of money. And so I'm always going to compare what you have in equity to Reg T to see if perhaps I can't loan you some more money. And so, here what we're taking is 50% of the market value. Reg T, 50%. And right now that is $20,000. And no coincidence, you are perfectly balanced. I mean, to be honest with you, most people are perfectly balanced on day one. The point is that every day is a new day. Now, to be successful in margins, it's kind of like when you get good at options. There's not nearly the payoff on being good at margin as there is a payoff on being good on options. But if you can do the initial setup, so that's what we've done here. We've done the initial setup. And then you can do a mark to market. So that's our initial setup. And you can do a mark to market. You're in pretty good shape. Because now they're going to say, several weeks later, or, margin and options both lend themselves well to what I call time clock questions. Where they give you some kind of a time clock and they say now it's at or whatever. And so now let's say that the stock is at 50. Stock goes to 50. And now the key to being successful, as we said here, is being able to do the initial setup. And then what we're doing now is what's called a mark to market. So we can do an initial setup and we can do a mark to market. Like I said, I'm pleased that you got a mark to market on your intellectual inventory on Series 7. So you got a couple marks on STC that look pretty good. And then you got a mark on Kaplan didn't look so bueno, right? So we're trying to find that real mark. So here now what I'm going to do is I'm going to market based on this. And then they're going to ask me, what changed, what didn't change, is there excess equity, is there SMA, whatever the case may be. Now, you can't do that unless you, do the mark. You can't be doing margin questions in your head. If you follow me sometimes on YouTube and mark options, I say, fire up the T. You got to be able to, kind of track the money. If you just can't be staring at the screen going, I don't know. So now what we're going to do is the mark to market. And so now you have $50,000 in market value. And again, what we're doing is the classical margin equation. And it is very testable to know the classical margin equation. To be honest with you, it might even just point blank ask you, what is the classical margin equation? It's long market value minus debit equals equity. Now, what you owe the brokerage firm hasn't changed. Again, I think the best analogy is the house again. Right? If the house goes up, the mortgage doesn't change. What happens is the equity goes up, right? So when you buy your house and you get your mortgage, I was just reading today that the housing industry has kind of slowed down because a lot of people have houses with great mortgages and they're doing equity buildup and they don't want to move. Right? Like, where am I going to get another 30-year 3% mortgage? And since I bought the place, things are looking good. So, and I thought, well, I guess that's, a different kind of perspective. But so here's a good example of a test question. They might even not even give you the numbers, which can be real challenging, right? They might just say the stock goes up. All the following ledger entries are affected except, as you can see here, the market value was affected. The equity was affected, right? Your equity went up $10,000. By the way, remember, equity always represents what you would have if you sold the securities and paid off the loan. Nobody's suggesting you do that, but that's what equity always represents. Now, pay attention here. If you did this in your cash account, you bought 1,000 shares at 40, and then the stock went to 50 and you sold, you would made $10,000. And here you're up $10,000 as well. So what's the difference? Well, the guy who did this in his cash account, 10,000 on a $40,000 investment is a 25% return. 10,000 on a $20,000 investment is a 50% return. Wow. So we're making money twice as fast. It's called leverage. Making a little money do a lot. Now, I should warn you, the same supercharged speed you make money with is the same supercharged speed you're going to lose money with. Right. So we're going to give you a disclosure document, saying, hey, you understand this could be hazardous to your financial health. Now, as I said, we love lending customers money. It's one of our all-time things to do. So I'm always going to compare what you have. By the way, I can kind of get rid of this because, this is yesterday's news. Customers get hung up on this all the time. As a margin clerk, every day is a new day. I just wipe it out, right? I can't tell you how many times customers go, well, yesterday or last week. And I said, well, Joe, that was long ago in a far off galaxy. Every day in a margin account is a new day. Every day we're going to do a new mark. And, some things will remain. I'll show you what they are in a minute. So as I said, now what I want to do as a margin clerk is we love loaning money. We said one of our all-time favorite things to do is loan money. And so as a margin clerk, I call you and say, hey, Joe, for customers like you that pick stocks that go the right way, we are willing to advance you a further loan. Reg T says you have to be at risk for at least 50%. Reg T says I can loan you up to 50% of the market value. So, as it stands right now, you have $5,000 more in equity than you need. And good news for you. As I said, when you have that, I'm willing to advance you a further loan. Now, please note again this question about all the following changes except. So please note, based on the mark, the only thing that remains the same from the previous mark is the debit, what you owe Goldman Sachs right now. And with this $5,000 in excess, you can either have that as cash. Again, it's like a house, right? The bank might give me an excess equity line of credit and say, hey, Dean, knock yourself out here. If I write a check, my mortgage goes up and my equity goes down. So you can have that as cash, or you can use it to purchase additional securities. My favorite would be purchase additional securities. And you say, well, Dean, I like it at 40. But 50 is a little rich for me. You say, do I have to do something today? Now, if I told you that you had to do something today, you might use this in a way that's not in your best interest. So I'm going to say, no, you don't have to do anything today, Joe. I'll tell you what I'm going to do. I'm going to make a special memorandum to your account that on today you had $5,000 more than you needed. I'm going to create a holding tank for that excess equity. So, if the stock goes back to 40, not a problem. If I didn't have this holding tank, you might use this credit in a way that's not in your best interest. So I say, no, no, no. If you don't like it at 50, my friend, you don't have to do anything. And with 5,000, you can have that as cash, or you could buy $10,000 worth of securities. 2 times your SMA is what we call your buying power. And again, that could be the test question, right? They could say, let's just put this all now into test phraseology. Your customer buys 1,000 shares at 40 and makes a required deposit. Several weeks later, several days later, tomorrow, the stock's at 50. Which of the following is true? They have 5,000 SMA, they have 10,000 buying power. Now, the other reason we like margin accounts, kind of like options, is there's no interpretation of the right answer, assuming you do the math correctly. Right now, tomorrow is going to be a new day. Every day is a new day. And so let's say the stock goes to 40. And remember, you told me you liked it at 40. And, if we go to do this mark, which we're going to do in a little bit, we're going to market to market again. Good thing that we made the special memorandum to the account, because as we said, this is history. Because every day is a new day. The one thing that doesn't go bye-bye is this entry that I made, that holding tank. That's still going to be there until you use it. If you don't do anything with that, that's still there. So I call you and I say, hey, you said you liked it at 40. You said you liked it at 40 and it's back at 40. Let me just do the mark here. And so now it's back at 40 and you told me that you liked it at 40. And you still owe the brokerage firm $20,000. And that's what the debit register represents. And how do you fill out increasing proportion ownership at 40? You bought it at 40, went to 50. And I remember we talked and you said you thought that 50 was a little rich, but you liked it at 40. And so here it is back at 40. You said, damn, Dean, I should have used my excess equity. It looks like I don't have any excess equity. I say, you certainly don't, my friend. But remember, that was the whole point of why I created that holding tank. And the reason I created the holding tank is because you're right. You do not have any excess equity, but you still have SMA that can be used as cash. And you can still buy $10,000 worth of securities. That was the whole point, by the way, of creating the special memorandum to the account. So that's the one thing that doesn't go bye-bye. Now, as I said, let's look and see what happens if you use your SMA as either cash, or if you use it as a buying power. So I'm going to send you, as a margin clerk, I'm going to send you in just a sec, either $5,000 in cash or $10,000 in securities. Now, our favorite would be that you buy securities. And with SMA of 5, you can buy securities of 10. So now, again, we're doing a mark, right? The key to this is to be able to do the initial setup and the mark to market. But I'll let you pick. You play client, I'll play margin clerk. Would you like $5,000 in cash, or would you like $10,000 in securities? I mean, by the way, I could have called you here and you could have said, well, Dean, to be honest, it's kind of embarrassing. I do like it at 40, but I'm having a little bit of a liquidity crisis. And, I don't really think I should be adding to my stock position. In fact, I think I might even have to sell some. I said, well, how much do you need, Joe? And he said, well, I'm thinking about writing like one of those Visa checks for like $5,000. I said, well, Joe, don't do that. That's outrageous. You need $5,000? More than happy to send you $5,000. I had a client once, and it was kind of funny. He was telling me the bank wouldn't give him a loan. And his name was John. I said, John, what happened? I mean, how could you not get a loan? And he said, they asked me if I had a job, and I told them I didn't have a job. And they said, if I don't have a job, I can't have a loan. I said, well, John, didn't you tell them that you don't have a job because you're rich? I mean, what did you get? Like the teller or something? I mean, anyways, I said, well, John, I said, I'm more than willing to lend you. What do you need? He goes, I need $1 million. I go, not a problem. You have $5 million in fully paid for securities with me. So if you want $1 million, I'm more than happy to send it to you. And he was kind of funny. He goes, what's the loan approval process? I go, you're approved. And he goes, what's
That's
the monthly
funny.
payment? I go, there isn't one. This compounds against the, debit balance. And I said, but, before you do that, maybe go back to your bank and tell them that your broker said if they won't give you the money, that I'm more than happy to give it to you. Right. So,
Mhm.
yes, I was joking. David Solomon, your CEO, is retreating from the retail part of our business. And,
Mhm.
which makes sense. I mean, we'd rather have guys like Mark that we get a little $1 million a pop instead of, somebody with a
Right.
credit card with like $500. Anyway, so what do you want, my friend? You want cash or you want additional securities? Your choice.
We'll do cash.
Okay, so now remember, again, what we've got to be able to do here is kind of like if you can get there, Joe, on the margins will become like options, and that there'll be no way to fool you. If you can do the initial setup, you can do the mark, and that's what we're about to do now. And then remember, they ask you what are the changes in ledger entries,
Mhm.
what's going on. So you want cash, so there's still $40,000 of long market value in your account. Now, the only way you get your own money out of a margin account, so let's just label this, we're using our SMA as cash, is to sell securities. Again, it's kind of like the house, right? The only way you get your own money out of the house is to sell the house and pay off the loan. That's the only way you get your own money out of this thing. So now you owe the brokerage firm 25,000. The 20 we originally lent you, and the 5,000 I'm sending you now. And remember, sometimes they ask you, like, what are the ledger entries here, right? So what didn't change is the market value, but you just drew down on your equity. Again, it's just like the house again on an excess equity line of credit, right? If you write a check or access the excess equity, mortgage goes up and equity goes down. And again, as we said, we always want to see if perhaps we can't loan you more money, because that's one of our all-time favorite things to do. And so once I get equity, I'm always going to see if perhaps I can't loan you more money. Now, there's no such thing as negative excess equity. You either have it or you do not. And so I'm going to compare this to Reg T to see if perhaps I can't loan you more money. And half of 40 is 20. There's no such thing as negative equity. But now you're below 50%. And it's not a problem. Nobody's going to bother you when you're below 50%. It's not a problem. You just put yourself below 50, and I, as a margin clerk, have no problem with you for doing so. There's only one new rule when you're below 50%. The new rule when you're below 50% is if you sell securities. By the way, if you just say sell securities, I'm a margin clerk, I'm paying down your loan. If you owe Goldman Sachs money and money comes into your account, Goldman is going to use the money to pay down the loan. Now, if you don't want Goldman to do that, then you got to say, hey, don't be paying down the loan. Because, if I'm a margin clerk and I'm looking at your account and there's some money coming in, I go, well, let's pay down what he owes us. So here, the only new rule when you're restricted, you say, well, gee, Steve, you never used that word before. I said, well, it didn't matter, Joe. Joe's this now. You're now below 50% equity. And the restriction, Joe, is that moving forward, you can only have half the sales proceeds. If you sell from here on out, you can have half, and then we keep half to pay down your loan. And you say, well, gee, Steve, I don't need the money. I said, well, great. Now you take all the money, pay down your loan. You said, well, geez, now that you brought it up, Dean, I kind of think, well, maybe I should get it if I can't get it later. So this is the one time and the one time only that I'm going to make a special memorandum to your account that is not a functional mark to market. I say, Joe, if you leave all your money in the account, I will credit your SMA for the half you could have got. That is the only time that the SMA is not a function of the mark to market. The only time I make an SMA entry as a margin clerk indirectly that isn't a function of marking you to market is if you're restricted and you leave all the money in the account. Then I credit you. By the way, it's one of my favorite kind of go-to tricks because I'm trading you real money for a credit. Right, so that's kind of a nice trick. There's $10,000 worth of sales proceeds. That's real. I pay down the loan, and then I say you can borrow $5 later on. No, that's in my world. That's a great kind of thing as a margin clerk to be able to do. Now, if you don't want to do that, remember we said you have to leave half of the account. Now, this is all based on you having gone past 50%. Now, you don't get more SMA unless you get past your high water mark. So, here's 50%. And we're saying that if you're in here, you have excess equity. And we said if you go below here, you're restricted and you can only have half the proceeds. And you say, Dina, sounds like great fun. He says, but you say, Dean, how far down could my account go before there would be a problem? I said, well, why are you sending out negative energy like that? Right. So you're asking me how far down it can go. I said, well, we can figure that out. What we can do. I say, minimum maintenance on your account, very testable, Joe, is 25%. And again, very testable. Goldman Sachs's house requirement can be higher. Trust me, it is. The house requirements can always be more stringent than whatever the minimum is. And you said, well, Dan, I didn't ask you what is minimum maintenance. I said, I asked how far down could the account go before there would be a problem. And the way we're going to do that, that's called market value at maintenance. Market value at maintenance. Kind of a nice number to be able to calculate. Is the debit, what you owe Goldman Sachs, divided by 0.75. And if we do that right now, you owe Goldman Sachs 25,000. So we take the 25,000, we divide by 0.75. And boom, I'm doing my calculator. 0.75. Ooh, 33,333,333. So that is market value at maintenance. And that's pretty helpful because now what I'm going to do, Joe, is I'm going to mark you to market at 30. Now, I already know that 30 is going to be a problem, right? Because I know that 30, if I do the mark at 30, I know that's a problem because it's below 33,333. If I did the mark at 35, I would know there's no problem because 35 isn't below that number. So that number is what we're going to look at here next. But before we do, we did say that the other thing you could use your SMA for is we said you could use it. Instead of as cash, we said you could also use it to buy additional securities. So I want to show that what that looks like. Right. By the way, they're linked. If you use it, you lose it. So you say, Dean, let's increase the position, which is kind of cool, right? If you have a margin account, and I told you you don't have SMA, but excess equity, but you still have SMA, and you still have buying power. And you say, Dean, I want to use my buying power. And I say, okay, so you want to buy $10,000 additional. And now on T+3, we're not using any of your money. We're using the broker-dealer money. So now you owe us $30,000. The 20 we originally lent you, and the 10 we're lending you now on T+2 to pay for the stock. You had $20,000 in equity, and I told you that's why you got to be able to do the mark, because they might ask you, the customer uses the buying power, all the following are affected except. And please note here, the equity is still $20,000. It's just that now it's carrying a larger loan. As we've said, we always want to compare to Reg T to see if perhaps we can't loan you more money. And so we're always going to compare, 50% of the market value of your equity to see if perhaps we can't loan you more money. Again, there's no such thing as negative excess. You either have it or you don't, right? So please note, you put yourself into restriction again. Not a problem. It's not a problem. We don't mind if a customer puts themselves below 50%. By the way, it's still a fully collateralized loan. I mean, in a house, I let you put up 5 and I loan you 95. Here, I'm making you put up half and I'm lending you half. So, it's a pretty good loan in terms of collateral value. All right. So the only new rule now moving forward, remember, is now that you're below 50%, your account is restricted. By the way, Joe, if you don't like that, some clients don't like to be restricted. So well, send me $5,000 and that will remove the restriction, right? Because if you send me $5,000, what am I going to do with the $5,000 if you send it to me?
Deposit it.
Yeah, remember, if I'm a margin clerk and you owe the firm money and you don't tell me what to do, I'm going to pay down the loan. That's just what I do, right? So let me just get this here and I'll just show you what happens if we pay down the loan. So there's that. And so now, remember, you owed me 30, you send me 5, and I pay down the loan. That's what I do as a margin clerk, if you don't tell me any differently. And now you're perfectly balanced. You're no longer restricted, right? 15 minus 25 is 25, right? So we pay down the loan. All right, well, now this changes as well, right? This also changes because now market value maintenance is going to be 30,000 divided by 0.75. Right. So figure out how far down the account could go. We would, take the debit register and we would divide by 0.75. And so again, boom, boom, boom.
And then for the short market value, it's divided by 1.3, right?
That's exactly right. That's
Okay.
exactly right. All right. So let's do a mark here. Let's just do this one here. Boom. And you say, Dean, what is maintenance on the account? I say maintenance on the account is 25% of 40. That's 10. You have 20. So right now you got no problem. And you say, well, Dean, I didn't ask you what is maintenance on the account. What I asked you is how far down the account could go before there would be a problem. So we're going to take the 20,000, whatever that debit register is, and we're going to divide by 0.75. And that gives us market value of maintenance. And so now that's a market value maintenance. And so now I'm going to mark you to market at 24 grand. So we already know that 24 grand is a problem. Yeah, I call you up and I say, hey, Joe Dean here, margin clerk. We're getting a little concerned because we're only holding $24,000 in collateral. And you said, well, Dean, you never called that collateral before. I said, well, I used to be your broker, but now I'm your banker. And, I'm a little concerned because you only have $4,000 in equity. And, we think if you don't have enough skin in the game, you might walk. We don't want that to happen. I say at all times to maintain your account. Now, by the way, we already know this is a problem. We already knew that because 24 is below 26,666. So we kind of already knew there was a problem here, right? So I say to maintain this account, minimum maintenance. Now be careful. I'm going overkill because this is your session, right? You're an opening purchase of a tutoring session. You're long. You have the choice, but not the obligation, right? And you said you want to do some margin stuff. So I just warn you not to get too carried away with this. But anyways, just be careful if you do get this question, to be careful what you're being asked. RTFQ, read the full question and read the full answer set. What I'm hinting at is there's a difference between asking you, what is minimum maintenance? That answer is 6. And asking you, what is the maintenance call? Those are different questions. So I say, Joe, of the 6, there's already 4 in your account. And so the maintenance call, again, be very careful about what you're being asked. The maintenance call is the difference between the 6 and the 4. And so you have a maintenance call due promptly. You say, well, I thought I had T plus 2 plus 2. I go, Joe, that's a margin call. A margin call is a call for initial money. This is not a margin call. This is a maintenance call. Those are different things. Now, we'll never tell you what, promptly is, because when we say, sorry, that wasn't prompt enough. And if you send me $2,000, I pay down your loan. Remember, that's what I always do with money. So if I take the $2,000 and I pay down the loan, that's now 18. And your equity is 6. You're back at minimum maintenance. I'll call you again tomorrow. I'm joking, but usually stocks that are going down continue to kind of move against you, right? Mm-hmm. All right. So we went through the history of a long account. We went, took it up, we took it down, we looked at the maintenance, and you kind of hinted that that there are also short accounts. So let's look at a short account. In a short account, remember, there is a locate requirement. There is a locate requirement. Now, I am a fan, and we're on Zoom right now. And I do worry about my friends at Zoom because, Microsoft is starting to bundle, Teams into video conferencing, and Google's starting to get away. And I'm like, ooh, man, my poor friends at Zoom. So, even though I like them, doesn't mean Dean is not going to try and make a buck if I can. And so, maybe I decide it's time to sell short Zoom. And so the first thing, remember, is there's a locate requirement. I can't just, sell short 1,000 shares at Zoom. I got to be able to borrow it. So Goldman Sachs says, well, Dean, let us check with stock loan. Let's see if we have a customer who has signed the loan consent form. And so you call me, say, Dean, we were able to borrow 1,000 shares of Zoom. And we'll assume that Zoom is trading at $70 a share. So I'm going to sell short 1,000 shares of Zoom. And I'm going to make the required deposit. So remember phraseology on margin accounts.
So when you sell short, that means that you don't have the shares, and then when you
That's
sell
exactly
long,
right. That's
it means
exactly
that you
right.
have them, right? Because
That's
I had that question once
exactly
often.
right. That's exactly right.
Okay.
I joke in most businesses, when you sell things you don't own, it's called fraud.
Yeah.
In our business, right? So
Mhm.
be careful. This is where most people get hung up. I'm going to get $70,000 from selling the Zoom stock I don't own. But remember, Reg T says that I have to put some money with that. And how much am I going to have to put up to get this done?
35,000.
Right on. I'm going to have to put up the Reg T requirement, which in this case is going to be 35,000. Because, I have to be at risk for some money, right? That's my Reg T requirement. And we'll call that our Reg T deposit, just to kind of keep that straight in our mind. And let's put that there, boom. And so I have in my account 35 plus the 70. The credit balance in my account is 105,000. And that's where most people get hung up. Where did that come from? It came from $70,000 from selling the stock that I don't own, plus the $35,000 I had to put with it. Now, the second ledger line is still what I owe. But now what I owe are not money. What I owe are securities. And the securities I presently owe are valued at $70,000. So, in a margin account, a long account, what you owe is money. And in a short account, what you owe are securities. And on day one, as is typical, I am perfectly balanced. How often are people perfectly balanced? On day one. I'm joking, but not really. And so that is test question number one, the classical margin equation short. The classical margin equation short. Now, by the way, they might even just ask you to identify that. Same deal now, same deal. What I mean about the same deal is now we're going to do a mark to market. So remember, we call this, as a test taker, when you get this phraseology, the first thing you say is, I got to do my initial setup. That's my initial setup. And then remember, they're going to give me some whatever, and I'm going to do a mark to market. So we're going to, almost always have to do, the initial setup and a mark to market. Okay, so where do we want the Zoom to go?
You want it to go down.
Yeah, maybe they report their earnings and they say, damn, it's hard for us because, Microsoft and Google are giving our shit away for free. So, what are we going to do? I'm joking.
Right.
The European community today told Microsoft they can't bundle the video conferencing into the Teams because, that's, antitrust, they're The Europeans are a little concerned about things like that than we are, but anyways. So here now we're going to do the mark. Let's see, Zoom goes to 60. So Zoom. So we should know that we're going to be happy campers here, right? Because that's what we wanted to do. We want to sell high and we want to buy low. We are bear, and bears want things to go down, pause down. Yep. And we still have, again, $105,000 in cash in our account here. 70 grand from selling the borrowed stock originally, and the 30 with the 5 that we put with it. But now if we went in the open market, nobody's suggesting you do so. But if we went in the open market, bought back the borrowed stock, gave it back to the person we borrowed it from, it would only cost us $60,000.
And then 45,000 for equity.
Yeah, that's right. And then remember, so now where we're going again is we're going to do the mark. Please note, remember these test questions? All the following are affected except the credit register wasn't affected here. We had 105 and we still have 105. And now your point, the equity has gone up. We've actually made money from the stock going down, right? If we bought back the borrowed stock and gave it back to the person borrowed, we'd walk with 45. Now, remember, we always want to see if perhaps we can't let you pyramid the position, get deeper. And, we're willing to let you go deeper if you are smart enough to pick stocks that are going the right way. And so what I'm going to compare, and this is where you got to be careful on the short account. I'm going to compare this to the market value, which is now the second ledger line. Right, so you got to be real careful on a short, all right, because this is 50% of the 60. And so that's 30. Woohoo! That's 30. Woohoo, my friend. We do indeed have excess equity. And so as it stands right now, you can have $15,000 in cash, or you can sell short an additional $30,000 in securities.
Right.
You say, do I have to do something today? I said, no, because we don't want you to, get yourself in the hot water. I mean, listen, if you don't feel like doing anything today, Joe, that's fine. Tell you what I'll do. I'll make a special memorandum to your account that on today you had 15,000. I'm going to create a holding tank for that excess equity so you don't lose it. Because remember, every day is a new day, and every day I'm going to mark you to market, and all those ledger lines up top there are going to go poof. What's not going to go poof is the special memorandum that I made to your account. Right? By the way, this is yesterday's news, so we can get rid of this. Customer get home. That's yesterday's news. Tomorrow, that will be yesterday's news. And so we're going to leave that there. And you can have that as a cash, or you could sell short additional securities. That would be my favorite. Now here, if we're wrong, it goes which direction?
Up.
Yeah. And how far up could it go?
Unlimited.
That's right. So, I always joke, don't be a dumb bear. When you are selling short, you are exposed to unlimited risk. And so you might want to consider, if you don't want to be a dumb bear, you might want to consider risk mitigation. There's a couple things you can do here if you want to be a smart bear. I always joke, don't be a dumb bear. One thing we might want to consider, in fact, why don't we just figure it out? You say, well, Dean, how far up could it go before I would have a problem? I said, well, Joe, why are you sending out negative energy like that? I said, at all times, you need 30% of the market value in equity. And you said, Dean, I didn't ask you what is maintenance on the account. I asked you how far up the account could go before there would be a problem. And the way we do that is we take the credit register. And you gave this to me earlier, 1.3. And this is what we call market value at maintenance. Now, the reason I'm doing that, I'm going to tell you in just a minute why I'm doing that. 105 divide by 1.3. Market value at maintenance is 80,000. $769.23. And so what we might want to consider doing I'm not sure how much we are willing to lose, my friend, but I definitely think we should probably consider putting in a buy stop somewhere before maintenance. So one thing we could do is put in a buy stop. And maybe I recommend a buy stop, certainly something less than 80, right? Because we don't want to have to deal with that. I say, so, how much are we willing to lose here? Part of successful investing is letting your flowers bloom, but more importantly, pulling a weed. And this thing's a weed. Daniel Drew, legendary Wall Street speculator, said those that sell what isn't hisn't must eventually buy it back or go to prison, right? So we got a little bit of a problem. Maybe we decide to do, we'll lose approximately, because remember I said that, my former friends at Zoom, but maybe the guy who founded Zoom, he's a former WebEx engineer guy. So no wonder, Zoom is pretty good because, you got to hear people bitch about what they didn't like about WebEx. Anyways, but let's say, he just calls Google or he calls Microsoft, says, hey, we're giving it up, man. You guys are too much for us. So how much will you give us? And Google says they'll give them $200 a share or some crazy thing. I go, well, so much for my thesis on that short position. Right. So maybe, that's not good. Now, there's another thing we could do as well. What's the other arrow in our quiver?
Is the Reg T.
Well, another thing we might want to do in risk mitigation is go long a call. I say, how long do we want the protection in place, Joe? Longer term options have greater premiums. And you say, well, maybe we go out to December. And I say, where do we want to put the ceiling? Without either a buy stop or without the call, there is no ceiling. This thing could just blow up against you. And so, we're shorting at 70. Maybe it's at 60, maybe we're protecting profit, who knows? But maybe we say, again, as your broker, I would suggest that we certainly don't want a call that kicks in after we get a maintenance call. I would want a call that would kick in, when we, time to go home, right? And so that'd be another thing we could do. Get some protection. All right. So a couple little other kind of margin kind of things. There are some securities, prior to 1934, we as broker dealers were in charge of margin to our customers. And when we were in charge prior to 34, you'd give me 10%, I'd loan you 90%. You give me 10 grand, I'd loan you 90 grand to purchase securities. And that was called the Roaring 20s. And everybody had great fun. In the end of 34, we said, well, maybe broker dealers aren't the best decision makers about credit extension to their customers. And so we took it away from broker dealers and we gave it to the Federal Reserve Board. And so the Federal Reserve Board is the one who says that you have to initially be at risk for 50%. The Federal Reserve Board is the one who says customers get 2 additional days to pay for purchases. T plus 2 plus 2. But they also say that there are certain securities that are ineligible for purchase on margin. In other words, there's certain things I can't lend you money to buy. One they test you on is options. Right? If you want to buy that assumed December 175 call, you have to pay in full because options are ineligible. Another one that's ineligible are new issues. And so, you call me and say, hey, Dean, I missed the IPO allocation. I didn't get any IPO allocation. And I say, well, Joe, what can I tell you? At Goldman Sachs, we have other customers that are more important than you. No, I'm joking. I wouldn't say that part. You wouldn't say that. You wouldn't be discriminating.
Hopefully not.
Yeah. I say, hey, no hard feelings, Joe. Let's just step into the open market and let's buy it there. It's now trading in the secondary market. So just pick up 10,000 shares in the secondary market for me. And let's do it in my margin account. I say no can do. What do you mean no can do? It's considered a new issue 30 days from the effective date. So, hey, Dean, this company went public a while back. I'd like to buy it in my margin account. I go, how long ago did it go, public? And you say, well, does it matter? I go, it does, Joe. I mean, you say 6 weeks ago, I go, no problem. We can do it in your margin account. You say 2 weeks ago, no can do. Gonna have to do it in your cash account. Now, it's not a separate rule. It's not a separate rule. But remember, every share in a traditional open-end mutual fund is a new share. So again, you can't buy an open-end mutual fund on margin. Now, if you've had the open-end mutual fund for more than 30 days, then you can deposit it as collateral. Now, the other thing here, one other funky thing, this is stupid but testable. So the phraseology we're looking for is new account or initial transaction. New account or initial transaction. So the self-regulatory organization says that our minimum is going to be $2,000. Very testable, stupid, but testable.
Right, I got that. Asked that.
Yeah, definitely on the test, right? So the trick here, so there's 3 versions of this trick. The first version, as you say, Dean, sounds like a wonderful idea. Let's open up a new margin account. Let's buy 100 shares at 18. I know how margin accounts work. I'll send you $900. I said, well, Joe, if you had an existing margin account with me, that would be correct. But we have a minimum of 2. And you go, well, I'll send you 2. I go, whoa. Why, Joe, would you want to send me $2,000 to buy $1,800 worth of securities? So in a new margin account, first version of this trick, if you buy less than $2,000, you're just going to pay. Because it would be foolish to, put up $2,000 to buy $1,800 worth of securities. Second version of the trick. You say, Dean, sounds like a wonderful idea. Let's open the account. Let's buy 100 shares at 30. I know how margin accounts work. I'll send you $1,500. I said, Joe, if you had a existing margin account with me, you'd be correct. You'd send me $1,500. But a new margin account, you need to have up a minimum of 2. So you need to send me 2. So second version of the trick is between $2,000 and $4,000. You're going to send me $2,000. And then the last version of the trick is there is no trick. Right? So you say, Dean, sounds like a wonderful idea. Let's open a new account. Let's buy 100 shares at 50. I know, Dean, new account. I'll send you $2,000. I go, no, Joe. 100 shares of 50, Reg T is 2,500. Send me 2,500. So past $4,000, there's no trick in play, right? It's just like any other margin account. So I call that stupid, but testable. Stupid, but testable, right? A couple more, just a little more kind of things here. As a margin clerk, if you buy and sell on the same day, I'm not going to net that. I'm not going to do 2 marks, right? So if you say, Dean, sell 40,000 and buy 50,000, all I do is net that. I say, okay, well, Joe, what we're talking